All right, we're live, and it's Wednesday's Real Talk on Real Estate. And I want to talk to you guys today about whether or not real estate is actually a good investment in 2024. Okay? So, one of the big things that people need to realize right now is that real estate is always a good investment. If you look at historically, real estate from the 1930s, during the Great Depression, all the way to today, there's one constant variable. And it's the fact that real estate has continued to appreciate over the course of time. And so it's the same question, about stocks. Like, is today a good time to invest in stocks? Is it a good time to invest in crypto? It's not if you should be investing, it's how you should be investing. Because those people that are looking for like a quick win in crypto, this is not the time for a quick win. Now, if you're looking to play the longer game in electronic currency like Bitcoin or some of the other ones, it's a great time to invest, right? Because you'll just sit on those assets. And we are moving to electronic currencies. It's inevitable. The world is already semi-electronic. Everything you do from these right here, from these phones, right? And so it's electronic. Money doesn't really exchange hands anymore. I remember back in the day when we started a construction company, I would have people show up with $6,000, $10,000 in just cash in greenback $100 bills. Now, the last time that's happened to us, very few and far from. It doesn't happen very often. So it's becoming more electronic. So great investment, right? Long term. Stocks, same thing. If you look at them constant from the 1930s to today, just like real estate, there's been one consistency. They have continued to grow and appreciate in value over the course of time. Now, obviously, it depends on the type of stocks that you invest in. Me, I tend to do big blue chip companies, big companies that all pay out dividends. And I will not invest in a company that does not pay out dividends unless I know that they're going to pay out dividends in the future. For sake of example, Boeing, they're not going out of business. There's two major plane manufacturing companies in the world. Boeing happens to be one of them. They got crushed during the pandemic. And so they were taking government bailout money. The stocks got crushed. They stopped paying dividends. Now, historically, they've been a dividend-paying stock, but there's a clause that the feds have that if you take bailout money from the feds, until the feds are paid back in full, you cannot be paying out dividends to stockholders. So you buy low, anticipating the growth of the stock, but then you also get dividends on the back end when they pay back the feds for the government bailout money that they get, and then you get the dividends long term, okay? That's the only way I'd buy a stock that isn't. That's just one simple example, okay? But we'll buy like Johnson & Johnson. We'll buy companies like Intel. There's a couple big companies that we own, I don't even know the names of them, that compete with Intel, but are larger chip manufacturing companies than Intel. They're not going out of business right now because automobiles, for sake of example, I used to have a 2020 GMC Denali, and that thing had 6 chips in it. Every 3 years I get a new vehicle. I have a 2023 GMC Denali. That thing has 32 chips in it now. So computer chips are only getting more prevalent in vehicles. I just bought a Jeep Gladiator, which I'm jacking up and lifting right now. And this thing's all electronic. It's crazy, man. Like if you look at Jeeps just 10 years ago, they weren't like this at all. And now there's a bunch of computer chips in those Jeeps. So cool, yeah. I like the old school, beat up, rough, ragged Jeeps. But point being is that there's a lot of computer chips that are going into these. Great stock to invest in. Pipelines, it's like transport, transportation. There's always going to be a need for transport. So we invest in big transportation companies. A lot of tech companies, medical device companies, because medicine is always going to be here. Companies like Johnson & Johnson, they were in a massive lawsuit with that talc powder. They settled the lawsuit. So the day they settled it, I bought a bunch of stocks because over the course of time, that's going to go back up even though they got crushed in that lawsuit. Okay, so these are just examples. Now, how does this relate to real estate? Okay, now, real estate, same thing. It depends on what you're buying and how you're buying it. So let's talk about that specifically, because 2024 indefinitely is a time to buy real estate and invest in real estate. It's just knowing knowledge of what and how to do it, what to invest in and how to invest in it. And so in 2024, ladies and gentlemen, yes, you should be investing in real estate. And if you have never invested in real estate, the first investment you should make is in your own personal education. Because I know that back in like 1993, when I didn't know shit about business, about real estate, about anything, I just devoured information. I had a cassette tape player that was about this size. And what I would do is, let me show you guys this real quick. Let me show you. You'll love this. This is cool because this is the actual real cassette tapes. I used to listen to these cassette tapes, and this is just one, How to Win Friends and Influence People. Now, they're beat up. They're beat up because I've listened to them for years. But check this out, guys. Self-education in real estate is important. Look at Addicted to Life, okay? That's that side. This side of the tape is Never Give Up on a Dream. It's just personal growth stuff, that helped me in business. This other tape right here, tips on interviewing, like how you talk to people, tips on how I interview people. The backside of this tape doesn't even have a label on it. Don't even know what the backside is. Average versus successful. New prospects, how to deal with them. Persistence beats resistance. Time and energy. Confidence is key. I devoured these every night before I went to bed. I would just put those things in and I would listen to them because your subconscious mind is the strongest state of mind that you have. And most people don't even realize this, but that state between awake and asleep is where your brain is the most vulnerable. That's why if you're in a bad relationship and you're fighting before you go to bed, it's toxic to you. If you're studying and you're in college, that's the time that your brain absorbs the most. If you're self-educating yourself and you indulge your mind at the time that you're falling asleep, it's the most vulnerable state of your mind. So make sure that you're giving your mind good stuff. Don't be watching negative bullshit on the news, okay? So that's the first thing you should be investing in as far as real estate is concerned in 2024. Now, second thing that you need to be investing in is you need to be investing in cash-producing assets. Okay, now there's active income. There's assets that have active income and there's passive income. What's the difference? Active income is income that takes you facilitating the growth of that business and the generating of capital. So one thing that I always tell people is buying land and building houses. It isn't passive income. It's not residual income. It's just large active income. And you need that because that income is income that you need to pay your mortgage if you have one. I'm mortgage free, but most people in the United States have mortgages. If you have car payments, if you need food to put on your table, if you're paying electric bills, gas bills, water bills, if you're paying for school education for your kids, the clothes that you wear, all that stuff takes active income that comes every single month. Okay, so I love buying land, building houses because I can make six figures and I can do, a handful of them at a time. And it's a great asset class to invest in. Why? Because right now there's a lack of housing. We need over 7 million rooftops. And historically, we as Americans can only build approximately 11 million homes in a 10-year period, over a decade. And so if there's a 7 million deficit and the population continues to grow and we're in need of an additional 7 million on top of that, that means that it's going to take us at minimum of a decade to catch up, even if we did everything perfect. So that means you have a minimum of a 10-year opportunity in the single-family home sector, which is awesome. That means you got plenty of time to go out there and crush it. Now, passive income is income that produces cash in spite of your own efforts. That's when you invest in assets that are rent producing, that you can lease if you have office or you're repositioning something like office, retail, warehouse, or multifamily. And it just so happens that the number one multifamily asset class you should be paying attention to is that has an affordability component attached to it. Now, what does that mean? I was just on the phone with a young lady. Her name was Ruth. She is part of our Build Wealth team. And Ruth came and said, Jerome, should I go in and work on getting an affordability? Should I make my apartment complex, which is 95 units, affordable? And through the government standards of affordable. And I told her no. And the reason why I told her no, not right now, is because once you attach and make your apartment complex an asset that has an affordability government program assisted to it, they can limit and they can give you rent caps, and you're limited to those rents indefinitely unless you can get that affordability component taken off, which typically there's a fine or fee that's attached to it. And so I told her, don't do that. All you need to do is add an affordability component to your multifamily. Now, what does that mean? What's the difference? The difference is if you take like her 95 unit apartment complex and you go in and you seek an attorney and you work with an architect to go out and sell the city on adapting your multifamily apartment complex as an affordable multifamily apartment complex. And so if they say, yes, your apartment complex is now an affordability, it has our affordability tax abatements to it, we're going to give you incentives. We're going to give you all the affordability incentives that come with it. All the tax incentives, the property tax incentives, the tax abatements, all of that stuff you're going to get because now you are compliant and you are creating an affordable housing concept that we ourselves can put lower income and lower financial earning people into, and we're going to cap your rents though. So there's stipulations. I don't like stipulations. I don't want to be in a position where I have stipulations on my assets. I work too hard. I want to make sure that if I have the ability to push rents and I have the ability to increase my profits and my net operating income and the value of my asset, I'm going to do that. But now here's a caveat to that. So here's like if you're in Texas, listen, because this is like Texas is like the key component to this, right? And this is where Texas is where we really sat back and said, okay, we cannot build these assets because rents are so damn low here unless we add an affordability component to it. Now, what are the attributes to an affordability component to a multifamily apartment complex? That doesn't mean that you make the entire complex, all 95 units, affordable. You only added a component, a small component of 15 to 20%. Now with that, there is a ton of tax abatement opportunities that you can have from a federal level and a state level that go all the way down to a municipal and local level. Okay, nationwide. Okay, nationwide. State, statewide. Municipal, city, or municipality, the county that it's in. Okay, so you have multiple different tax abatement opportunities that you can take advantage of just by adding an affordability component, a small percentage. Usually it's 15 to 20%. Now, here's how you function and you run these assets in that regards, okay? It doesn't matter if it's a 10 unit, it doesn't matter if it's a 15 unit, it doesn't matter if it's a 100 unit, a 200 unit. Look, here's how you facilitate around an affordability component. And I recommend that everybody adds an affordability component to their multifamily apartments, whether it's a 4-unit or a 400 unit. It doesn't matter, anything in between. Because once you add that affordability component to it, you get the tax benefits that come along with it, okay? Now, if you're only limited to 15 to 20%, what I always tell, like my business partners, I tell them, hey, look, watch, let's say we have 100 units. That means that 20 of them I have to make available, okay? I have to make available as affordability. That doesn't mean that, let's say you get to 80% and 0% is leasing affordable multifamily units from you. That doesn't mean you just leave 20% empty. So what I told them is, I said, let's just market the shit out of this thing. Let's fill the doors with everybody and anybody that has good credit, that are credit-worthy tenants. And we just have to, when somebody asks, we don't market the affordability component, but when somebody asks, we have to make available at least 20%. Now, here's how it works. Nationwide, there is typically a 5% revolution in tenants, which means that if you have 100 units, that nationwide, on average, 5 tenants are going to leave your property and you're going to bring 5 new ones in. So there's a revolution of about 5% every single month. That's just a national average. Okay, so if you have 100 units, 5 units typically change tenancy in every single month. So if that's the case and you have 100 units, 5 units is 5%. Now, if you have 5% and you have all 5% that want an affordable model because they qualify for the standards of affordable housing under government stipulations, guess who has to dominate in first position over a regular sedentary, a normal person that doesn't, and I shouldn't say normal, a normal revenue producing person that doesn't have an affordable approval on a governmental level. they come secondary to the people that have an affordability component to them. So you just have to make them available. That means that you may have 85% or 90% of your property leased at full rent rates where only 10% are on the affordability component. But if the next month you just have a heavy month of people that want of an affordable component because they're government approved for it, you have to make them of those units available to them until you hit your cap of 20%. Then after that, you can deny it. You can deny everybody else. But if you don't have it, you don't have to wait for them. You just lease up your property. And that's literally how you add an affordability component to it. Okay, now, here's how and what you buy. Okay, so when you go in, you can't raise rents to force appreciation, but you get consistent cash flow. Yes, you can. Now, if you just add an affordability component to it, a lot of times I try to do, there's multiple different affordability components and tax abatement strategies you can use, not just one. So they're all different. All of them are different. Some of them require you that you sell the land to the municipality and do a 100-year lease back. I don't like that one. There's other ones where you don't have to do that. The vast majority of them you don't. But then there are some that do have rent caps, and then there's a vast majority of them that don't. Okay, so you just have to study, and there's consultants. Typically, your architect will lead you to the right consultants that you can hire to find out about some of these tax abatement strategies. We typically utilize lobbyists that specialize in real estate and real estate law. And where do you find these lobbyists? We go to the national association. We go to the local associations of realtors, and we ask them who lobbies with them for their bills to pass state level legislative bills during the legislative session every single year. And we go do an outreach to those people. And we typically may hire them for $5,000. Now, if you're just starting out, don't pay for that. But if you're doing like a multi-million-dollar project, a $2 million, $5 million project, $5,000 is a drop in the bucket. It'll be worth its weight in gold for you to pay them, because they will help you out with networks of people that can help you with the affordability components. And sometimes they'll even give you like development fees for offsite development, maybe $1 million, $2 million to put in utilities, infrastructure, streetlights, curbs, gutters, stuff like that. Okay. Now, how do you know what to invest in? This is super important. Now, if you go in, you want to, right now, what a good buy is in real estate is anything that has a 7% cap rate or better, because it runs in parallel with interest rates. A lot of investors are still buying stuff sub 6% cap rates in spite of interest rates being high, because they believe that long-term interest rates are going to stabilize and come back down, and it's still going to be a win-win situation for them. Now, that's too risky for me. I don't like doing stuff based on the speculation of the market doing better. I want to know that I'm buying something that in today's market, I have an exit strategy that is 100% viable. And if something happens where I can't lease it and I can't get it cash produced, I just dust my hands off, sell it, and I walk away from it without getting bloodied up financially, walking away from it. I need an exit strategy, okay? So with that said, if you can buy something at a 7% cap rate or higher, it's a great buy right now. Buy it. Especially if it's an asset class that's desired, like warehouse, office warehouse, industrial warehouse, flex warehouse, multifamily, affordable housing, Section 8 housing, stuff like that. Those are asset classes to invest in right now. Now, if I can get a deal where I can leverage, I have higher leverage. What that means is there's a debt component to your purchase and an equity component to your purchase. The debt component is what the bank typically brings to the table, and you typically are paying a debt service on it. There's an equity component that's either you bring the down payment of 20% or better to the table, or you go out and raise money through giving away that 20, 30% equity to investors. And the more leverage you can get in debt from the bank, the easier it is to leverage the equity, because you have to raise less money, or it's more forgiving on your personal bank account if you're personally buying it. And so an asset where I can get better leverage in this market at a lower interest rate, I am all about. Okay, I'm all about it. So I will take leverage over the lack thereof all day long. okay? Because if I have to raise the equity, either that means I have to get more money out of my own pocket or I have to raise more capital. And right now is a hard market to raise an exponential amount of capital in, because the bond market is high. People have great investments that are more risk-free and diversified than real estate. And so real estate right now is getting the raft of the high interest rates because of the expense of money right now. And so if you can go in and get more leverage right now, all day long, buy. Okay, because you can refinance later. Even if the interest rate is high, if you can get leverage, even at a high interest rate of like 9%, 8%, even 10%, take the leverage and refinance later. Just buy the asset, especially if it's a good buy right now. Okay, and you always want to buy something that cash flows, ladies and gentlemen. That is super important. You always want to buy something that cash flows, because if it's cash producing, it's profitable. And if it's cash producing, you can service the debt. Doesn't even matter if you don't make nothing right now. I have worked for free my entire career. And what I mean by that is I'll buy stuff and I'll work for free for 2 years, 1 year, 5 years. And then at the end of it, there's a reward. In 2008, I went in and I spent over $850,000 accumulating over 64 units of fourplexes. I was buying garbage fourplexes for like $40,000, $38,000, $42,000 in Phoenix. I landed up selling that entire portfolio for over $3.5 million. And not only that, I invested into an apartment complex I bought for $8 million, which has since increased to over a $15 million asset. Took an $850,000 investment and turned it into $15 million that I own. Okay? That, ladies and gentlemen, is what you call leverage on an asset. And I'll tell you, there was a time that I wasn't making a ton of money on it. It wasn't until the market started going up exponentially. So I just sit on it. Right now in today's market, I'll build an asset that's a $70 million asset. I'll build it. And at the end of it, if I can just get it out of the ground and I can just get it to cash flow and pay its debt and the investors, and I even make zero money, it's okay. Because you know what I know what tomorrow holds? Is an increase in the valuation of real estate. How do I know that? Just look at historically what real estate's done since the 1930s to today. And one thing that I can bank on is the fact that the affordability of housing is only going to continue to go up, and my ability to generate capital on the assets that I invest in is going to continue going up over the course of time. So if I can get these things cash flowing, paying for themselves, and stabilized, even if I don't make a ton of money, I'll depreciate the crap out of it, pay zero income taxes, and just sit on that asset, let it pay for itself over the next 2 years until the market repairs itself. And then in 2, 3, 5 years from now, I'll do a cash out refi. I'll refinance the whole thing at a lower interest rate. Then I'll have better cash flow and I'll pull capital out of it. That's my payday. And I'll still have my cost segregation and my tax depreciation, which allows me to not pay any income taxes on a federal level until I actually exhaust that write-off to the amount of the asset and its value. Okay, so now I'm kind of going down a foxhole here, and I don't want to go down a foxhole. I just want you guys to realize that right now is a great time to buy, even if you can only stabilize and sit on that asset, because tomorrow brings much sunnier days with a ton of profitability. And when the sun shines, it's going to shine on ours greatly, and we're going to have a friggin' heyday with all these assets. So ladies and gentlemen, 2024 most definitely is a year to invest. If you like the content, want more of it, pound that thumbs up button, click and subscribe to our YouTube channel for more content just like this. Ladies and gentlemen, God bless you guys. Go out and continue compounding your success. And until next week, on Real Talk on Real Estate, you guys go out and crush it. God bless. Have a great weekend.